dollar yen is on track for its first week of gains since June. The unwind of the carry trade that drove part of the market sell-off we've seen has slowed throughout the week. That slowing coming on the heels of better than expected economic data and dovish commentary from the Bank of Japan. So the big question, will the slowdown of the unwind continue here? Joining us to discuss, we've got Mark McCormick. He's TD Securities Global Head of FX and EM Strategy. Mark, great to have you as always. So you talk about this in your note. You say that the BOJ pivot has likely ushered in a regime change for the yen. Given that, do you think the unwind of the carry trade is over for now?
I do not think the carry trade unwind is over. I think we have a long way to go. I think you need to think about whether it's kind of tactical and the structural nature of it. The structural nature of the carry trade is that for pretty much around the last decade, Japanese investors have put their money, mostly pension funds, which accounts for about 80% of GDP, in other markets. So the assets that they're tracking in other markets are actually a big form of the carry trade. It's hard to say this is yen specifically. You know, they're betting on higher yields in other places. But a piece of this carry trade, if you look at the correlation of the NASDAQ to the yen, is the outperformance of U.S. equities and probably investments we have in Japanese pension funds into those U.S. equities, which have been very strong performers over the last 5 to 10 years. So I think a big piece of the yen carry trade is it links together a lot of these different global themes, which is it was very, very easy to fund in yen. And it was very easy to find other places around the world that offered higher yield or higher growth. And now the entire complex around that system is now starting to unwind.
So then, Mark, what kind of adjustments have you made, or are you advising investors to make if the pain isn't over yet?
We've been talking about this for months. Like, we have pushed back. I think we had the same conversation probably in April or May around the Goldilocks trade. To me, this was, you never know the catalyst, but the conditions for volatility to rise, I feel like, is not very surprising. I feel like what we're trying to do is piece together what caused this, like U.S. data slumping. I would highlight as well that if you look at Chinese data, it's slumping faster than U.S. data, and Eurozone data is also declining. If you look at the uncertainty around the U.S. election or geopolitical uncertainty, we had macro volatility basically setting back to levels that we were in 2021 after the world reopened from the pandemic. So the levels that we saw in global macro vol versus all the conditions that can change them, it's always hard to get the precise trigger right of what causes this thing to unwind. But for me, it was very clear that the thing that was going to happen is we were going to have a series of events the markets weren't expecting. Namely, we were looking for the BOJ to hike in July. This, to me, was a function of, again, that the currencies that are undervalued, that are short plays in the carry basket, are also the currencies that the U.S. administration has called out on being undervalued, whether it be the Korean won, whether it be the Japanese yuan, whether it be essentially the Japanese yen. These are all currencies that are fundamentally undervalued. So I still think that the drivers in place is something that we have a long ways to go for the carry to unwind. And we're probably in a new regime where, again, the Goldilocks trade is essentially fallen by the wayside.
Is the Chinese yen the next carry trade unwind that investors should look out for?
So that's a great question, because I think you need to kind of disentangle the correlation of the yuan versus the yuan. They have re-correlated right now. They're being driven by similar factors. So the Chinese yuan is a good funding for a carry trade. And again, if you just think about what drives a carry trade in markets, why people love it, it's very simple. It's what you need is rate divergence. So one country needs higher rates, another country needs lower rates, and you need low volatility. So you assume the conditions are not going to change. That's also what makes it very vulnerable to very violent drawdowns, which is what we've seen. So what I'd say is the coupling of the correlation between the Chinese yuan and the Japanese yen makes sense because they are both funding currencies. Mechanically, as we move out of what you would call, say, the period of the next couple of weeks and into months and quarters, I think they're going to probably recouple again, because I think they're two undervalued currencies, and I think they need to both be stronger. But I think in the short term, the BOJ is moving in a direction that's going to continue to tighten policy. The yen is way more undervalued than the Chinese yuan. And I think a big driver here is that Japanese flows, or pension funds particularly, have been pushing money outside of Japan. They will be bringing money home. They will be resetting their asset allocation targets to buy more JGBs and buy more local equities. And I don't think you have the same capital market mix in China. So that's where I do think we'll see divergence in the next couple of months, as the yen should outperform the yuan. But I think if we measure this in terms of like over the next year, over the next 2 years, they should both be currencies that strengthen relative to the dollar.
So, Mark, that was the comparison of currencies I wanted to ask you about, but now I want to do a comparison of tech to currencies. If you're a tech investor, I feel like this week really had you looking at the dollar yen, and I'm curious if the reverse is going to be true. If we get bad NVIDIA earnings, for example, does the yen appreciate off of that?
It's hard to disentangle cause and effect in all this because there's so many pieces. I think one thing that you could take away from the kind of the undermining of the yen carry trade and where we see the yen strengthening, where we see, again, the BOJ hiking, and we're calling it Japan Inc. The government, the pension funds, and the central bank now seem to want a stronger currency. The one consequence of this is if you think about where a lot of money has gone from Japan, you could track that money as well, is it's gone into European bonds. They have picked up yield in France, they've picked up yield in other European markets. So a consequence of these flows kind of repatriating coming home is, one, real rates go up. So curve steepen, real rates go up. This is challenging for tech, largely because tech is like premised particularly on easy money and easy monetary conditions and low interest rates. So I would say, it could be either or. Like if NVIDIA is weak and that continues to see a further drawdown of risk sentiment, that would strengthen the yen. But also, again, the yen basically rallying because there's a repatriation of capital coming home, and that's causing basically a trigger of interest rates to move higher, particularly real rates. That could also be a catalyst that kind of provides the same outcome and sees earnings start to decline as well.
Yeah, Mark, to that point, at the catalyst of all this, it seems to be this growth shock, right? What does that then tell us about the wild swings or the volatility that we could then continue to see play out, given not only uncertainty here in the U.S., but also just on a global scale as well?
It's a great question because I think investors have been just focused on the U.S. and its U.S. is slowing. If you look at Fed pricing for 2024 and 2025, the Fed is supposed to be the most dovish central bank in the world next year. That makes very little sense to me. Again, because if you look at like the impulsive data that we track, that we run through our models, that we trade in currencies as portfolios, if you look at data surprises, data trends, and you kind of look at the change in consensus growth expectations, China's in a worse place than the US right now. So you can't have the US slowing down, China slowing down, and Europe essentially not growing that much, but coming from very low levels. The European momentum has already deteriorated as well. If you look at just global manufacturing PMIs, essentially the global economy is now deteriorating. So I'd say, again, a big piece of this is that you can't have this risk-on sentiment and low volatility with the uncertainty around the elections, the uncertainty around geopolitics, and again, have an environment where we're moving away from carry trades. That's just one that is not conducive to very low macro volatility in a weak dollar. So I think the global growth picture has to be taken in the context that if the U.S. is slowing, other countries have to offset it to allow risk sentiment to be stable. So I would say, again, what we're seeing is a marked slowdown in global growth expectations, which is not great for overall sentiment.
Mark, the control room's going to kill me, but I've got 30 seconds. I got to ask you about a technical issue that we're potentially approaching. If we see the dollar yen hitting around 146, is that a key level that we could see furthering the unwind and therefore leading to what might be another big sell-off of stocks as we head into Monday?
I'd put it this way. I think the fast money, the positioning indicators that we track that could be kind of more hedge funds that are kind of taking very tactical views on this, I'd say a lot of that carry trade is unwound. Again, the point that matters to me is if you just measure the carry trade through the balance of payments, you probably have $1.5 trillion just on the Japanese side of assets that are in foreign markets. So I would say, in a very short-term period, I don't think the levels matter too much because, again, I do think that the positioning market has adjusted a lot where our models are now long the yen. That's probably squeezed out, very short-term sentiment, like fast money chasers. But I would say, arguably, again, this is just the start of a move where if you just put it in this context, the valuation of our longer-term dollar-yen model tells us we should be about 120. So in the context of 146 or we started at 160, there is a long way to go to price out the valuations in the end. So I think, I don't think it's going to have a very big impact in the short term because I think a lot of those positions have been cleaned out. But over the medium term, I think the dollar yen is moving sharply lower, which should have significant implications outside of just the currency market.
Mark, everyone who wants to understand what will happen next with the carry trade needs to go back and watch that segment over the weekend. Thank you so much for joining us and giving us that clarity as always. That was Mark McCormick. He's TD Securities Global Head of FX and EM Strategy.